Welcome to Charged Alpha. Today we're dissecting Roper Technologies, ticker ROP. The stock just printed a Q1 2026 beat on April 23rd, and yet shares sit 38% below their 52-week high.
That's the puzzle, Hudson. EPS came in at $5.16 against $4.99 consensus, a 3.4% beat. Revenue hit $2.095 billion versus $2.062 expected. Margins expanded again. The market shrugged.
Lana, this is the 8th straight beat. Organic growth printed 7%. ARR base tops $2 billion. So why does the tape look like Roper just guided down? That disconnect is the whole episode today.
Because investors are repricing software. Roper trades at 22.1 times trailing earnings versus a historical 30 multiple. The fundamentals never broke. The multiple did. That's a sentiment story, not an operating story.
Roper Technologies is a diversified technology compounder headquartered in Sarasota, Florida. 3 reporting segments, but the soul of the business is now vertical software. The industrial heritage is fading every quarter.
Application software runs 40.8% of revenue. Think legal practice management, education, ERP, government compliance. Network software is 30.4% RF, tolling, digital communications. Tech-enabled products is 26.1% and shrinking as a mix.
The genius is the portfolio model. Roper buys founder-led vertical software companies that dominate small niches, 70% gross margins, mission-critical workflows. Customers literally cannot rip them out without operational chaos.
And the financials prove it. Trailing 12-month gross margin sits at 69.4%, EBIT margin 28.9%, net margin 21.1%. These are pure software numbers wearing an industrial conglomerate ticker.
Here's the real magic, Lana. CapEx is $52 million on $8.1 billion of revenue. The FCF to CapEx ratio is roughly 50 times. Asset light doesn't capture it. This is a capital-light cash machine.
Operating cash flow hit $2.604 billion trailing. Free cash flow $2.552 billion. That cash funds the next acquisition, which feeds the next AR cohort. The flywheel is real and it's spinning.
So why now? Why this episode, this quarter? Because the setup is unusual. Earnings keep beating, margins keep expanding, and the stock is down 38% from $584 to $363.
That drawdown happened despite consistent execution. Q2 2025 EPS 349 beat 342, Q3 514 beat 511, Q4 521 beat 514. Now Q1 2026 516 beats 499. 4 for 4.
Forward consensus for fiscal 2026 is $21.50 in EPS. At $363, that's a 26 times forward multiple. Compare that to Roper's historical 30 times. There's roughly 15% of multiple to recover just on mean reversion.
Add the $1.5 billion buyback that's actively running. Management is repurchasing shares at 22 times trailing earnings, the cheapest the stock has traded in years. That's a confidence signal worth respecting.
Catalysts beyond the multiple. ARR compounding above 10% annually in software, potential platform M&A in legal reg or healthcare IT, and continued margin mix shift toward 45% EBITDA margins as software dominates.
Plus the optionality on a re-rating if the market finally classifies Roper as a pure-play software compounder rather than a diversified industrial. Index inclusion in software baskets could pull in incremental flows.
Let's talk leadership. Neil Hunn has been president and CEO since 2018. He joined Roper in 2011 from Bain Consulting. He didn't inherit the playbook. He architected the pivot from industrial products to software.
Under Hunn, Roper divested industrial businesses, leaned into vertical SaaS, and built ARR past $2 billion. The discipline matters. He targets founder-led companies, pays reasonable multiples, and does not force aggressive integration.
That hands-off integration philosophy is rare. Most acquirers crush culture and rip out cost. Hunn lets the operating CEO keep running the business. Result, founders stay, talent stays, customers stay, ARR stays.
The numbers validate the approach. 28 consecutive years of dividend increases, steady margin expansion every fiscal year, grows from 67.5 in 2022 to 69.3 in 2025. That's not luck, Hudson.
His scorecard against industrial tech CEOs over the past decade is elite. Now let's grade the latest scorecard. Roll the numbers, Lana.
Q1 2026 revenue $2.095 billion, up about 11.9% year over year. EPS 516, 3.4%, above consensus. Organic revenue growth 7%. The acquisition contribution explains the rest.
Trailing 12-month revenue $8.115 billion. TTM EPS 1643. TTM net income $1.714 billion. The waterfall is clean. Gross profit $5.631 billion. EBIT $2.28 billion. Net $1714.
Margins improved every fiscal year since 2022. Gross 67.5 to 69.3. Operating 27.4 to 28.9. Net 17.5 to 20.4. That's structural mix shift towards software showing up in the P&L.
Balance sheet, cash $383 million. Total debt $9.301 billion. Net debt $8.918 billion. Net debt to EBITDA 2.87 times. Manageable but not pristine. M&A has consumed capacity.
Total equity $18.818 billion. Total assets $34.551 billion. Goodwill $21.348 billion. That goodwill number tells you everything. 62% of assets are accumulated acquisition premiums.
Forward estimates, fiscal 2026 revenue $8.52 billion, EPS $21.50. Fiscal 2027 9.06 and 23.31. Fiscal 2028 9.77 and 25.49. That's a high single-digit revenue compounder with low double-digit EPS growth.
Dividend 364 annualized, yield 0.95%. Payout ratio just 21.2%. 28 straight years of increases. Plenty of room to grow the dividend without straining FCF.
Now let's see what the street thinks. 24 analysts cover the name. Consensus rating is hold. 14 buys, 7 holds, 3 sells. Mean price target 445. That's 22% upside from here.
The bull camp is loud. Piper Sandler at 510 overweight. TD Cowen 490 buy. Raymond James 480 strong buy. Truist 470. Jefferies 465. Citi 460. 6 buys above 450.
The bears are sharp too. Barclays 360 underweight, basically pinned to current price. JP Morgan 340 underweight. Mizuho 330 underperform. They argue multiple compression has further to run.
The middle is where the recent action sits. Goldman 415 neutral. Stifel 400 hold. And this matters. Stifel downgraded from buy to hold on January 28, 2026. Oppenheimer downgraded the same day.
2 downgrades on the same day in late January coincided almost perfectly with the slide from highs. That's the moment the narrative shifted from premium software compounder to pricey industrial roll-up. Sentiment, not numbers.
RBC sits at 430 sector perform, a fair value handle. So the dispersion is wide, 330 to 510. That spread tells you the street can't agree on whether Roper is a software compounder or an M&A junkie.
Let's build the bull case. First, the ARR base above $2 billion is compounding at over 10% annually. That's recurring, sticky, mission-critical software revenue with 70+% gross margins. It only grows.
Second, free cash flow conversion is extraordinary. $2.552 billion of FCF on $8.115 of revenue is roughly 31% FCF margin. That funds $2.5 billion of annual deployable capital without dilution.
Third, the valuation is the cheapest it's been in years. 22 times trailing, 26 times forward against a 30 times historical norm. If sentiment normalizes, you get re-rating tailwind on top of earnings growth.
Fourth, management is buying its own stock aggressively. The $1.5 billion buyback is active right at these levels. Insiders aren't selling. Capital allocation discipline under Hunn has earned the benefit of the doubt.
Fifth, margin expansion runway. Gross margin already 69.4%, operating 28.9%. As application and network software grow faster than tech-enabled products, mix shift continues to lift consolidated margins toward 45% EBITDA territory.
Now, the bear case. First and most obvious, the stock is down 38% from 584. That is not a typo. Something the market sees has overpowered 4 straight beats. Falling knives can keep falling.
Second, acquisition-dependent growth. Strip M&A and organic growth is 7%. That's good, not great. The whole compounding thesis hinges on Hunn's team finding more high-quality vertical software targets at reasonable prices in a competitive market.
Third, leverage. Net debt to EBITDA at 2.87 times is elevated for what investors increasingly think of as a software business. Rising rates raise the cost of the next deal and compress the return on incremental capital.
Fourth, integration and goodwill risk. Goodwill of $21.3 billion is 62% of total assets. One large impairment at a portfolio company could rattle the entire thesis and force a painful conversation with the rating agencies.
Fifth, organic deceleration risk. Roper's verticals include local government, transit, education, and legal. A budget-driven recession in any of those slows ARR growth, and software multiples compress fastest when net new ARR rolls over.
Now let's look at peers, Lana. Where does Roper sit on the valuation map?
Ametek trades at 5.8 times sales with 8.2% revenue growth. Danaher 6.2 times sales, 5.1 growth. IDEX 4.9 times sales, 4.3 growth. Rockwell Automation 3.7 times sales, negative 2.1 growth.
Verint sits at 2.1 times sales, 4.8% growth. Pure software but smaller and slower. Roper is 4.61 times sales with 11.9% revenue growth. Best growth in the cohort, mid-pack on multiple.
That's the bull's punchline. Roper grows faster than Danaher and Ametek and trades at a lower price to sales than either. If you believe software-like margins justify a software-like multiple, the gap should compress in Roper's favor.
The bears would counter that Ametek and Danaher have cleaner balance sheets and longer industrial track records. ROP's premium software label is what's being challenged. The peer comp depends on which bucket investors decide to use.
On to options and insiders. Options flow is neutral to slightly bearish. Implied volatility is elevated after the 38% drawdown. Put-call ratio is above 1 near term, which signals defensive hedging rather than directional aggression.
That's not surprising. After a 40%-ish slide, holders buy puts to protect what's left. New buyers don't aggressively bid calls until they see a base form. Today's tape has neither capitulation puts nor euphoric calls.
Insider activity is quiet. No material purchases or sales in recent quarter. Modest insider ownership given large-cap institutional dominance. Honestly, the corporate $1.5 billion buyback is the meaningful insider signal here.
That buyback is doing the work individuals aren't. Management is signaling at the share repurchase level, buying at 22 times trailing earnings, even when individual insiders don't open their personal checkbooks at scale.
One more nuance. Beta is 0.89. Roper isn't a high volatility name historically, so a 38% drawdown on a sub-1 beta stock implies idiosyncratic concern, not just market beta unwinding.
Let's pull it together. Bottom line, Lana, what's the synthesis?
Roper is a high-quality compounder going through a sentiment reset, not a fundamental reset. Earnings beat, margins expanding, ARR over $2 billion, FCF over $2.5 billion. The operating story is intact.
Scenario tree. Bull case. Organic growth holds at 7+%. A meaningful platform acquisition closes. Multiple re-rates to 28 times forward. That's roughly $600, in line with Piper's 510 and the bull cohort.
Base case organic growth 4 to 6%. No big deal. Multiple stays at 26 times forward. Call it 420 to 450 range, right on top of consensus 445 mean target. That's the boring outcome.
Bear case. Organic growth slows below 4%. A portfolio company stumbles. Multiple compresses to 20 times forward. That's roughly the JP Morgan 340 handle. Maybe a retest of the 313 low. Painful but survivable.
What to watch over the next 2 quarters. Number 1, organic revenue growth. Q1 printed 7%. Anything below 5 would confirm the bears. Anything above 8 is a green light for re-rating.
Number 2, capital deployment. Watch for a platform acquisition above $1 billion. Roper hasn't done a marquee deal in a few quarters. A high-quality software target announced at a reasonable multiple would re-energize the thesis.
Number 3, software segment margin. Application software margin trends inside the next 10Q will tell us whether mix shift is still doing its job. We need to see operating leverage flow through every quarter.
Number 4, net debt trajectory. 2.87 times EBITDA is the line. If buybacks plus M&A push that above 3.2, the rating agencies notice and the cost of capital story changes meaningfully.
And the fifth thing, the buyback pace. 1.5 billion authorized. If management leans in hard at these prices, you've got a built-in bid. If they slow it, that's a tell that they see something we don't.
Final read, Lana. Roper at 363 is a controversial name. The bulls see a software compounder on sale. The bears see a leveraged roll-up at the top of an M&A cycle. Both can be right for different time horizons.
For me, the math is favorable but not screaming. 22% upside to consensus, a healthy buyback, 4 straight beats, 28 years of dividend hikes, and a CEO whose playbook has worked. The risk is patience, not principle.
That's our deep dive on Roper Technologies, ticker ROP. Q1 2026 earnings beat, stock down 38% from highs, 22.1 trailing PE versus historical 30. Decide for yourself whether the sentiment reset is opportunity or warning. If you found this useful, follow Charged Alpha wherever you get your podcasts, leave a rating, and share the episode with one investor friend who wrestles with valuation versus quality. We'll be back with more earnings deep dives soon. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street